All right, we're on a roll now. Let's continue talking about leases. It says here capital lease. Now this is from the lessee standpoint, not the lessor, but the lessee, the person who is leasing the asset from the lessor. Now, in a capital lease, we just talked about operating, true rental. Here in a capital lease, really it's substance over form. In substance, it's really like you're buying the asset, even though in form, it looks like just a rental. So it talks about substance over form, rights and risks of ownership have transferred. So that's one of the main things that we're looking at is have the rights, have the risks of ownership of this asset actually transferred from one person to the other. And we're going to talk about rights and risks of ownership under IFRS as well later on, but those words are important. Again, the rights and risks of ownership. Now, in looking at this, there are 4 criteria to determine if it is considered a capital lease. If you meet one of the 4 criteria, it's a capital lease. If you don't meet one of the 4, what is it? An operating lease. You don't have to meet all 4, just any one of the 4. So this is to see if it's a capital lease. And a good way to remember this, and I have a song that I'm famous for, is TTBPO 75 or 90. TTBPO 75 or 90. Title transfers, bargain, woohoo, right? It's a little dance song. TTBPO 75 or 90. Woohoo! And he's doing, what's that word? Twerking? What's the word? Twerking. TTBP. Anyway, so what does this mean? TT means title transfers. That means that by the time the lease ends, the title transfers from the lessor to the lessee, TT. That means that the lessee is going to own the asset. They're going to have the pink slip to the Porsche. They're going to own it. If they're going to own it in 5 or 10 years, wouldn't it make sense to just debit the asset today as if they purchased it? Wouldn't it make sense to just debit and start depreciating it? Wouldn't it make sense that you should pay executory taxes, insurance, and maintenance? Yeah, because in substance, it's a purchase, even though in form it looks like a rental. In reality, the rights and risks of ownership have transferred. In other words, the rights and risks have transferred from the lessor to the lessee, title transfer. BPO is a bargain purchase option. Bargain purchase option. What that means is you can buy this asset at the end of the lease term for a bargain. At the end of the lease, the asset's worth 30 grand. You could buy it for 3 grand. So let's think about it. If you give me 3, I'll give you 30. If you give me 3, I'll give you 30. Would you do it? Don't think too long. Yeah. So therefore, if you buy it, you're going to own it. That's a capital lease. The next one is 75% and 90%. Now the 75% says that if the lease term, and this is important, greater than or equal to 75% of its useful life. That means that you're leasing it for at least 3/4 of its life. That means you're getting most of the what we call economic benefit. Since you're getting most of the economic benefit, that means that we're going to debit the asset. Here says if the present value minimum lease payments of the MLIP is again greater than or equal to 90% of the fair market value at inception. So what that says is that if you're paying the present value of the future payments that you're going to be making are greater than or equal to 90% of the value, you're paying most of the value, we consider that a capital lease. Now, TTBPO 75 or 90, TTBPO 75 or 90, woo, Anyway, so that's the mnemonic or memory. How many need to meet? Any one of the 4, capital lease. Now in all of these cases, who is going to depreciate it? Well, it's as if it's a purchase and sale, the lessee will depreciate it. Now here's a little trick too, which I'll show you later. If it's TT or BPO, let's think, who's going to own it? The lessee will actually own it because either you get the title transfers, you get the pink slip, or you're going to buy it for a bargain purchase, you're going to own it, you're going to get the pink slip. Therefore, since you're going to own it, you're going to live with it until the end, depreciate it over its what? Useful life. So the useful life. If instead it is 75 or 90, did I talk about owning it? No, I said you're going to lease it for 3/4 of its life. You're getting most of the economic benefit, but at the end of the lease term, what do? You give it back. What about 90? You're paying 90% of the value. That's how much you're paying. But at the end, what do? You give it back. Therefore, you're going to depreciate it over the shorter of what 2 lives? How about useful life or legal life? The asset's going to live 10 years. You're leasing it for 8. It's going to be at the end of 8, you give it back. What's shorter? 8. You're leasing it for 8 years, but it's going to live 10. You're going to own it. Do 10. So that's where it's important to know, okay, the lessee is going to depreciate it over what? Here, useful life if it's TTBPO. Here, 75 or 90, shorter. What if you meet all four? Then you own it, so do the top. Okay? How many do you need? One of the four. Now, what if you don't meet one of these four? TTBPO, 75 or 90. What is it? It's an operating lease. So the fallback is operating lease. If it's not a capital, what is it? It's an operating. If it's not good, what is it? It's bad. All right? So that's what we're looking at as far as the lease. So you'll see there one of these terms. Now, if the beginning of the lease term falls within the last 25% of the life, criteria 3 and 4 shall not be used for purposes of classifying the lease. What that means is that let's say the asset is going to live 10 years and I'm leasing it in year 8. Okay, now how many years are left? 2. I'm going to lease it for what? 2 of the 2, which is 100%. But because I'm in the last, what? It says in the last 25%, I'm in the last 80%, right? There's only 20% left. So if you're in the last 25% of its useful life, then it says you cannot use the third or fourth criteria. So the only way you would capitalize it is if you're going to own it, TT or BPO. But if you're in the last 25% or more of its life, then what? Then you can't use criteria 3 or 4. Why not? Because we figure most of the economic benefits have already been used up. It's a 10-year asset. You're not going to lease it till you're 8, 9, and 10. You're getting the very end of it. You know what? Unless you're going to own it, don't capitalize it. So that's a special little rule that talks about TT, BPO, 75 or 90. Now, it says non-cancelable lease term because we're entering into what we call this non-cancelable lease. It says non-cancelable lease term is the minimum period of time during which the lease is expected to be enforced. So it's non-cancelable for that time that it is in force. It includes an initial lease term, that's the original term, that does not include any renewal. A bargain renewal period. It says there's an option to renew and it makes it likely that the lessee will renew it. Penalty for non-renewal. There's a penalty that if you don't renew it, it is a significant penalty, so you're not going to want to do that. And lease contains a bargain purchase, and the BPO, it's assumed if it's a good bargain purchase that it's going to be exercised. So that's what we mean by non-cancelable term. Now, we talked about the minimum lease payments. And remember the minimum lease payments, that over here we said that present value minimum lease payments is MLP, minimum lease payments, which we're going to expand on. But here let's see, it says, minimum lease payments represent the minimum amount that the lessee will pay or that the lessor will receive under the terms of the lease during the non-cancelable lease term. The minimum lease payments include. So when we talk about 90% of what? Present value minimum lease payments greater than 90%. What does minimum lease payment include? The base rent, the BPO, which is a present value of a lump sum, the bargain purchase. Any penalties are part of the minimum lease. Residual value. Now, a residual value is like a salvage value that we talked about. So let's say at the end I say, okay, I'm going to lease it, and at the end there's some sort of guaranteed value. If it is a guaranteed residual value by the lessee, then the lessee and the lessor both will include that amount as part of the minimum lease payment. If it is guaranteed by a third party or it is unguaranteed, then the lessee does not include it, only the lessor would include it. It says minimum lease payments would not include, so these are certain things that they exclude. They exclude certain things like contingent rents. If there's a contingent rent, which would be an additional rent based on things like sales in excess of certain amounts, or executory costs. What are executory costs? Taxes, insurance, and maintenance. Those are not part of the present value of the minimum lease payments. They're not part of the minimum lease payments. Those are expensed as incurred. So in that case, if I'm paying taxes, insurance, and maintenance, I don't put that as part of the leased asset. Instead, I just debit expense, credit cash, debit expense, credit cash. So these two elements, contingent rents and executory costs, are not considered as part of what? The minimum lease payments. So as we move forward, what are we saying? We're saying that there's a lessor leasing it to a lessee. On the lessee standpoint, there's an operating lease, lessor operating, true rental, pretty straightforward. From the lessee standpoint, there's a capital lease or operating. How do you know if it's a capital lease, everybody? TTBPO, 75 or 90. Title transfers, bargain purchase, lease term greater than 75% of its life, and minimum lease payments 90% or more. Now, as we look at these, they make sense. TT, title transfers, yeah, you're going to own it. BPO, you can buy it for a bargain, you're going to buy it. 75%, you're leasing it for at least 3/4 of its life, unless you're in the last 25% of its life. Present value, minimum lease payments greater than 90% of the fair value at inception, unless you're in the last 25%. But this one needs a little bit more explaining, because it says present value, minimum lease payments is greater or equal to 90% of the value. What is this minimum lease payments? So it says minimum lease payments. That's what we need to know, and we need to figure out how the heck to present value. So when we look at this, you'll see here the lessee records the lease at the lower of. So we're going to record this lease at the lower of what? We're going to record it at the lower of either fair market value or the present value of the minimum lease payments. So let's talk about present value minimum lease payments, MLPs. Now, what are the minimum lease payments? That would be, for example, the annual payment that you're making, what we call the periodic payment. So if I'm going to be paying you, let's say I want to lease your beautiful yacht. Okay, you have a gorgeous yacht over in the marina. And I go, how much for that yacht? And you go, I'll lease it to you for 10 years at $100,000 a year. So I'm going to present value $100,000. Now remember, we talked about present value with bonds, started to introduce you to the concept. We looked at present value tables at the time. We said, what is present value? It means $1, $1 a year from today is really worth 90 cents today. $1 2 years today is not $1, it's really worth 82 cents today. $1 3 years is 75 cents. So when you add all that, that's a present value of the annuity. Now, if I'm paying you $100,000 a year for the next 10 years, what did we say an equal stream of amounts to be received or paid is an annuity. An annuity, an equal amount to be received or paid. So we're going to present value what? The periodic payments. So that's the annual payments. We're going to present value the bargain purchase option as a lump sum. We're going to present value any kind of guaranteed residual value. So all of these are going to be present valued. What things do we not present value? We're not going to present value contingent fees or contingent rents. We're not going to present value executory costs. So I'm going to put not executory costs. Remember, what are executory costs, everybody? Taxes, insurance, and maintenance. What do we do with those? Debit expense, credit cash, as you incur those. So those we are not going to present value. Says here, penalty for failure to renew, which we mentioned and defined what it was earlier, you would include. Don't include executory costs since they are expensed as incurred. Now, we're starting to understand this. I'm going to debit an asset, credit an obligation under capital lease or a lease liability. In an operating lease, I don't debit the asset. Instead, I just debit expense cash as I make payments. But in a capital lease, you capitalize it. You debit an asset at how much? At the fair market value, not to exceed, or present value minimum lease payments, not to exceed fair market value. And what does present valuing mean? You present value the payments, the annual payment, the bargain purchase, the guaranteed, not executory. The question is, what rate are we going to use to present value it? You will use one of two rates. You are going to use what we call the incremental borrowing rate. Now, what is the incremental borrowing rate? That means that I go to the bank and I go, hey, Mr. Bank, I would love to lease this beautiful 75-foot yacht for $100,000 a year for the next 10 years. I need to borrow some money. How much are you going to charge me? 11%. Ooh, okay. So what is that? Incremental borrowing rate. That is the rate that I could go out and borrow the money on these terms. Or we're going to use the implicit rate. And the implicit rate, that is the rate implicit in the lease. So for example, what they're saying to me is they say, the owner, I say, hey, how much for your yacht? He goes, I'd like $100,000 a year for the next 10 years. $100,000 a year is a gross of $1 million. We know it's not worth that much. However, or $673,000 cash today. So whatever the rate is, where the present value of $100,000 a year for 10 years equals 673, that is the rate implicit in the lease. Who makes that rate up? Who makes up the sales price of the asset? The owner, the lessor. So therefore, that would be the rate implicit in the lease. That's called the lessor's rate. So that rate would be used. So when does the lessee use that rate to present value the payments? They use the implicit rate only if it is both lower and known. Now, what does that mean, lower and known? Lower than what? Incremental borrowing rate. Known by whom? Known by the lessee. The lessor knows the rate. They made it up, right? The lessor said, hey, I'm going to sell you my asset for $100,000 a year for 10 years or $673,000 cash today. Whatever that rate is, that's the lessor's rate. The lessee would also use that rate if it's both what? Lower and known. It says here, lessee knows the lessor's implicit rate and the implicit rate is lower than the incremental borrowing rate. That's the rate they're going to use. Note, the lessor always uses the rate implicit in the lease. So the lessor always uses the implicit rate. We're just trying to figure out what rate should the lessee use. So again, so you don't get lost, what are we using this rate for? To present value all of these payments. That is the rate we're going to use. So as you're going through it, we use it if the rate is lower than this rate. What I mean by that is if this incremental rate is 11% and this is 10% and it's known, we're going to use that. Now, the lower rate means less interest, means a higher carrying value, so the dollar amount may be more. But just look at the rates. So remember, it's the rate that's lower, not the dollar amount. And I'll explain that more later, but I just want to plant that seed right now so you start to understand it. All right? So those are some of the basics in stepping into it. What I want to do, though, is we have to figure out, okay, what is the accounting for this capital lease? How do we set that up in the books? We'll do that in just a second.